Okay, so hello, my dear chartered accountants. I hope my voice is audible. The PPT is visible. Yes. Okay, very good. Today is our last discussion on the crash course on fast track. So, in a way, let's say that is begin end. If couple of standards are remaining, in days 33 earnings per share is one of the slightly important technical standards. First of all, how to remember this number easily? Days 33. Very easy. What is the name of the standard? Earning per share, right? So what is the first letter? E. Last letter E. Just turn it backwards. It becomes 3 and 3 in days 33. That is what is the solution is all about. Another test paper I'm not giving. Just before exams, maybe in the month of October first week, I will release one mock paper for FR as well as SFM based on my pattern analysis. Okay, so based on the pattern analysis and my predictions, what could be the important questions for examination, I will release it in the month of October. That's what I'll be doing. Remaining mock exams will be available in the institute. You can take it. So my questions will be based on my expectation, based on my analysis. I will release. So let's go forward then. We have three types of EPS: current period EPS, previous year EPS, and then future year EPS. Answer key for that list series also I will share it today after this. I will share. Don't worry, I'll definitely. I don't have too many problems in this standard in the material, but I would like to make sure all the varieties are covered. Let me do that. First, we'll compute the basic EPS. One second. Okay, let's understand the basics now. Why EPS is important, I'm not going to discuss. You are SFM students, you know the best. Let's focus on the technicalities as aspects of it. So basic EPS. How do we calculate? Earnings available to equity shareholders divided by number of equity shares outstanding. We don't say number of, we say weighted average, but let's say number of equity shares. Now, few small points to be understood. Is profit after tax same as earnings available to equity shareholders? The answer is no. How do you calculate profit available to equity shareholders then? Then what we do is profit after tax minus preference share dividend. And what nature? To be specific, it is cumulative in nature. For cumulative preference share dividend, whether declared or not, we have to subtract. For non-cumulative preference share, only if you have subtracted, only if you have declared, only then it comes to this. If preference share dividend non-cumulative nature, if it is not declared, it will not come here. Only in the year when declaration comes, that year only it will be part of earnings available to equity shareholders by way of reduction. But one more technicality is important. Preference shares may be in the nature of debt or equity, right? Preference share may be in the nature of debt or equity. The preference share in the nature of debt, no need to adjust. No need to do PAT minus preference share dividend. No need, you need not do it. Why? Because the PAT would be already adjusted. PAT would have been already adjusted for it. Because when you know in the nature of debt, you would have done amortized cost method, where you would have calculated opening balance, on that interest, the preferential dividend minus payment, closing balance. So what is the debt element? Obligation of the entity towards preferential dividend is already considered as debt element, right? So to compute profit after tax, that dividend would have been taken as interest expense, not interest expense, finance cost. So PAT would be already recognized, adjusted for the finance cost. And for equity dividend, in the nature of equity, we follow this. Equity dividend, now we don't subtract. In the nature of equity, we have to follow this. So this is earnings available to equity shareholder. Sometimes some expenses will directly come in the balance sheet without coming in the P&L account. I'm not talking about OCI. For example, share issue expenses would have been directly adjusted in security premium. So few elements which are directly taken in other equity without passing through P&L account also should be considered for that year for the calculation of E. Okay, so this is regarding the numerator piece. Coming to denominator, so many things to be considered. Number of equity shares. If it is partly paid up shares, we take it proportionately to the extent of paid up, like a equivalent number of shares. Then issued during the year, then again proportionately for number of months outstanding. Then business combination, shares issued from the date of issue. Convertible debentures, from the date of conversion. Right shares from the date of issue of rights. What is important is bonus. It is taken from the beginning. Bonus shares, irrespective of the date of issue, you have to consider as if it is from the beginning. Date of issue of bonus does not matter. We take it from the beginning itself. Please tell me, do you want any example for this proportionate issue during the year to compute the weighted average number of shares? You want a simple numerical, or do you think you can understand it? If you want, I'll give a quick numerical. Otherwise, I'll go to the right shares and bonus share. And of course, convertible debenture. You want a numerical for partly paid up issue during the year? Okay, quick example. Okay, so suppose if it is like this, let's say, okay, so on April 1st, 2019, let's say company 1,20,000 shares of 100 each, 50 paid up. And on September 2010, 1st of September 2020, 2019, they called up the balance and everybody paid. Everyone paid except 24,000 shares. So this is one partly paid up and issued during the year. Both are there. So how do we calculate in this manner? How do you calculate in this case? So it can be done in 2-3 ways. I'll give the simplest possible. In a time travel, I'll explain. So on 1st of April 2019, you had 1,20,000 shares, 50 paid up. So proportionately we take 50 by 100. Till when? Till 1st September 2019. So for a period of April to September. So April, May, June, July, August. 5 months to 5 by how much you get here? 1st of April to 1st of September. 1,20,000 into 50 by 100 into 5 by 12. 25,000. 25,000. Now balance 1,20,000. 1,20,000. Okay. Now on 1st of September, what happened? That 1,20,000 shares there. No, it was 50 paid up, became 100 paid up because balance was called up. Everyone paid. So 50 paid up became 100 paid up for everybody. No, for everybody except 24,000. So 1,20,000 minus 24,000, 96,000 shares became fully paid up. And balance 24,000 shares who did not pay balance amount, they continue to be partly paid up. They were partly paid up, they continue to be partly paid up. So on 96,000, fully paid up 100 because first 50 was paid up, now balance 50 was paid up, fully paid up for a period of 7 months. 96,000 into 7 by 12. 56,000. And for this 24,000 partly paid up continues. So 24,000 they paid only 50 rupees, 100 for 7 months. 7,000. So total, if I add all 25 here and 56 plus 7, so that comes to 88,000. 88,000. But do you understand here what is the logic of considering proportionate number of months? What is the logic? Because in the profit after tax we divide by number of shares. Number of shares. Meaning what? Number of share is like our source of income, a source of finance, and profit after tax our result. Using our number of shares, using our source, we have generated profits. So numerator is profits, denominator is like a source for us. Now during the year, if I've issued the shares, that means source has come for us during the year. Source has come for us during the year. Therefore, the profit also would have started only after we start making use of the money. Since the source of money came between the year, The profit should start from that point onwards. So numerator would have been for that month, that proportionate after the shares coming to picture. The number of shares also should be after the date on which the source is coming to picture. It's a matching principle. Are you able to understand? When my number of shares coming to picture, only from that point I can make profit by using that. When number of shares are during the year, my profit also would be during the year. My profit during the year, therefore my number of shares also should be proportionately for number of months. So both can be matching in. Hope you understand this logic. The reason why I'm explaining this logic is because it will help us in ascertaining bonus shares. Hope you are clear in this example. Shall I go to bonus shares? Okay. Let me go to bonus shares now. Okay. Now tell me, bonus shares, what is the impact on shareholders' wealth? What is the impact on shareholder wealth? In the sense, when bonus shares issued, shareholders' wealth will increase, it will decrease, or it will remain same. Impact on shareholders' wealth. What do you think? The bonus shares will not have any impact on shareholders' wealth. Why? Suppose share price is 30 rupees. You issue bonus, the ratio 1:1. Share price will become 15 rupees. Now, when share price become 15 rupees, you should not think, oh, your share price reduced. No, earlier you are having one share of 30 rupees. Now you will have two shares of 15 rupees. Overall will be 30 rupees only. Shareholders' wealth is not affected. Sir, then why bonus shares are given? Same logic as in a rupee, you do a change, right? You do exchange, you do change. Like, which is better? One 2000 rupee note, or you have 20 100 rupee notes? One note or 20 notes? Both value wise same only, no? 2000, 2000. Value wise is not different. Value wise same only. So, the bonus share issue is like this. Whether when before bonus you are having less number of shares, more value per share. After bonus, more number of share, less value per share. Holding remains same. Then why bonus is done? Is it to cheat people? Is it to confuse people? Is it to give a wrong notion of making profits? No. This is because of the same reason. Is it better to have one 2000 rupee note, or is it better to have a 20 100 rupee note? When you want to transact, it's better to have a 20 100 rupee notes, because easy to transact, easy to give, easy to change. Because 2000 rupees note means for having coffee, tea, 5 rupees you have to pay. 2000 rupees cannot manage. Same logic. To induce liquidity into the market, bonus shares are issued. So what is the impact of this? Issue of bonus shares will not have any impact on shareholders' wealth, on company's net worth, or on company's earnings. So bonus impact is no impact on shareholders' wealth or company net worth or on earnings. No impact. So when the formula is profit after tax divided by number of shares, when you don't have any impact of profit, meaning what? By issuing bonus shares, company did not make any profit. Company is not getting any profit. That means profit is not affected by number of shares. So profit is not affected means number of shares also, how can I take it as proportionately? Company is not receiving a source. Bonus is not a source for the company. But still, as on date, it is pending. So what we should do? We consider from the beginning. We consider from the beginning. One more numerical example I give. Suppose company had 1 lakh rupee profit the previous year. In the current year also company made 1 lakh profit. Number of shares, they had 10,000. So EPS is 10 rupees. Now they issued 1:1 bonus. So 10,000, 10,000 more bonus they issued. So total number of shares become 20,000. The EPS become 5 rupees. Can you say, oh, this company share price has fallen, this company's EPS has fallen, very bad company. They got 10,000 more shares, but the profit did not increase. Very bad company, bad performance. Can you say? No. Why? This 10,000 is not a source for the company to make profits. The value of 10,000 and the value of 20,000 both are same. You cannot make more profit. So what do? I cannot change the current year 20 to 10,000 because as on day 20,000. So what do? Previous year 10,000, I'll make it as 20,000. So what will happen? 1 lakh divided by 20,000, that is also 5 rupees. This also 5 rupees. Now you can say company has not changed its operation. No change in performance. This 5 rupee of current year is called as basic EPS. Bonus shares are considered from the beginning of the issue. 10 rupee, what is reported in the previous year? Previous year reported EPS. What is the new 5 rupee what we got? New 5 rupee what we got is in the current year financial statement. To have a meaningful comparison, we change the comparative number. We change the previous year number. We don't go to previous year financial statements and change it. We don't do it. The comparative what we have in the current financial year as a comparison, the previous year figure, the current previous year column what we have in current year financial statements, for the purpose of better financial statements, we revise, we restate. That's called as adjusted EPS. So adjusted EPS means it's an amount relating to the previous year, but in the current financial statement, restated for the purpose of better and meaningful comparison with current year EPS for the events such as bonus shares, right shares, etc., which don't have any source of finance for the company. It can be bonus shares, it can be right shares to an extent, it can be stock split, reverse stock split, those kind of elements. Are you clear on the bonus? I'm not doing any problem. I'm only discussing the theoretical aspect. So bonus shares, the impact is for basic EPS from the beginning of current year. For diluted EPS, not diluted, for basic and diluted everything, for adjusted EPS, beginning of previous year. But you know, sometimes we prepare 3 financial statements, a change in accounting policy, restatements. So what about third column? Opening balance of that year. So it's beginning of earliest periods reported. If 3 financial statements are there, the beginning of that year, whenever it was there. Actually, you can say bonus is issued, assumed to be issued from the beginning of the company was formed. Like that you can think. From the earliest period possible, that is bonus. Okay, got it? Let me go for right shares now. Right shares. Right shares for basic EPS, if it is at the if it is the issued at the current year, for basic EPS up to the date of right issue and after the date of right issue. Up to the date of right issue, we compute like this: number of shares before right into m by 12, number of months, into adjusting factor. Adjusting factor, I'll tell you what is adjusting factor. After the date of right issue, it's calculated by number of shares including right into m by 12. Adjusting factor now does not matter. For adjusted EPS, that is for previous year. For previous year, number of shares, obviously previous shares means before right. Number of shares before right multiplied by adjusting factor. Basically, right shares means what? Shares issued to existing shareholders at a concessional price. In the concessional price, there will be free element, there will be bonus element. That bonus element is what is adjusting factor is all about. Let me give an example. Okay, what is adjusting factor? Adjusting factor is calculated by fair value of share before right divided by theoretical x right price, basically fair value after right. Theoretical x right means excluding right, not the right of your x, excluding right, theoretical x right price per share. That means after right. Numerator is before right, denominator is after right. What is theoretical x right price? How do you calculate? Number of shares before right multiplied by fair value plus right shares multiplied by right price, right issue price divided by total number of shares. Divided by total number of shares. Let me give you an example, numerical. Okay, let's say 1/4/2018 number of shares were 5 lakh. On 1/6/2018, they issued right shares 1 lakh at the right price 15 and fair value before the right, fair value before issue of right is, let's say, 21. How are we going to calculate? Okay. So, what is going to be theoretical x right price here? Theoretical x right price. Theoretical x right price. We had 5 lakh shares. fair value was 21. We issued 1 lakh shares at 15 rupees. So total net worth is numerator divided by denominator total number of shares is 5 lakh shares plus 1 lakh, total 6 lakh shares. Please compute this. Tell me how much you get. 5 lakh into 21, 1 lakh into 15 divided by total 6 lakhs. ₹20. 20 rupees. So what is the adjustment factor is going to be? Fair value before the right is 21, after the right is 20, so 1.05. So 0.05 basically represent bonus element. I'll prove it later. Okay. So for the purpose of computing current year EPS for basic EPS and for adjusted EPS. For adjusted EPS, what will be your number of shares going to be? Previous year 5 lakh multiplied by adjusting factor 1.05, 5 lakh 25,000. For basic EPS, what do? We do 5 lakh, again number of shares equals we do 5 lakh into 1.05, but only up to the date of issue. Date of issue 1st of June, so 2 months into 2 by 12. So how much you get? 5 lakh into 1.05 into 2 by 12. Get 87,500. And from the date of right issue, remaining 10 months, total 6 lakh. 6 lakh into 10 by 12, that is 5 lakh. Total we will write 5 lakh 87,500. 5 lakh 87,500. 10 months. Then whatever the profit divided by number of shares like calculated, you get the EPS. Okay, let me just tell you a quick interpretation of this. Quick interpretation of this. What is the consideration received? You have received 1 lakh shares of 15 rupees, means 15 lakh. Received 15 lakh. Now, what is this equivalent amount at fair value? If you were to receive 15 lakh by issuing at fair value, how many number of shares you would have received? Equivalent shares. At fair value, same 15 lakh. But you want a fair value of 20 rupees. Ex-rate price 20 rupees. So 15 lakh divided by 20, that means you get 75,000 shares. So you are supposed to receive at fair value 75,000, but you received 1 lakh being a shareholder. So what is the additional shares issued? Without consideration. Additional shares without consideration. 25,000 shares. Now this 25,000 shares is like bonus. And if you compute the ratio, 25,000 out of existing 5 lakh. 5 lakh, 25,000, right? So 25,000 by 5 lakh, how much you get? 0.05. That's what this 0.05 means. Bonus element. For every one share you have, you are giving 0.05 free of cost. Bonus element without consideration. So what we should do for basic EPS, for adjusted EPS for previous year? For adjusted EPS, number of shares is 5 lakh plus 25,000 fully, because bonus elements are from the beginning, right? 5 lakh 25,000. So this is what we consider for previous year EPS. For current year, for basic EPS, 5 lakh we take it. 25,000 from the beginning, full months. Then fair value equivalent 75,000 and fair value equivalent only for number of months outstanding, that is for 10 months. How much you get? Calculate 75,000 into 10 by 12. How much that comes to? 75,000 into 10 by 12. 62,500. And add all 5 lakh 25 62,500, we get 5 lakh 87,500. That's what this number would mean on an interpretation. Okay, so this is about bonus shares and this is about right share. Okay, so hope it is done. Any doubts in right shares, bonus shares? Okay, I'll take this part out then. Okay. Now, what we just discussed for the current year, EPS is called as basic EPS. And for the purpose of comparison, the previous year we restate. The restated EPS is called as adjusted EPS. Adjusted EPS, that is restated EPS. This is history. So this is this year, current, present. This is past. Now we have something futuristic. Past, present, future, 3 tense. Futuristic is called as potential years. That is future year, next year what could happen, assuming the earnings remain same. And potential EPS, all potential EPS we don't show it. We report only if it is dilutive in nature. Dilutive in nature. This is in line with prudence principle. Your current EPS, earnings remaining same, everything remaining same, but because of condition existing on the balance sheet date, the profit can go down, EPS can go down. That possibility of EPS going down should be considered by considering potential shares. What are potential shares? Convertible debentures may become shareholder, convertible preference share may become shareholder, share warrant, share option issued to employee, they may become shareholder. So assuming the profit remains same, but because of these uh, potential shares who are not shares now holder now, but they can become shareholder later. When they become shareholders, if the EPS is going down, is likely to go down because of potential shareholders, that possibility of EPS going down to be reported called as dilutive EPS. Sir, what if EPS goes up? It's called as anti-dilutive in nature. That is not reported. Not reported. That is also possible EPS. That is also futuristic EPS. That is also potential EPS, but not reported. So EPS due to potential shares, which is likely to go down, is called as dilutive in nature. Only dilutive EPS is reported. Anti-dilutive is not reported. Let me give an example. Convertible debentures. Okay, let's say you are having current year profit after tax of 5 lakh and number of shares existing, you have, let's say, 1 lakh. So we say basic EPS will be 5 rupees. Now you have convertible debentures. Let's say it is 8% convertible debentures having face value of 1 lakh, and this will be converted into 2000 shares, convertible into 2000 shares. 2000 shares. Now, when this debentures become shareholders, what will happen to this 1 lakh? 1 lakh will become 1 lakh 2000. Correct? That will increase by number of shares. Now, what will happen to this? That is 1 lakh plus 2000. 2000 will be increased by the shares, potential shares, when they become shareholders. Now, what will happen to profit? Assuming profit remains same, profit after tax, that is 5 lakh. What will happen to interest, debenture interest? Can you tell me, will the profit remain same, profit will increase, or profit will reduce? When debenture becomes shares, number of shares will increase. What will happen to profit after tax? What will happen to profit after tax? Profit after tax will increase because you save interest. So 1 lakh into 8%, 8,000. You save interest. And after even you should consider tax impact. This interest into 1 minus t you should do, because when you save debenture interest, your profit will increase and you have to pay tax also on that. Government will take its share. So into 1 minus t you should do. Here no in tax benefit, but you should remember it is increase in the profit due to interest is interest into 1 minus t after tax. When they are not debenture holder, you don't have to pay interest. You save interest, profit will increase. So how much this will come to now? 5 lakh 8,000 by 1 lakh 2,000. 5 lakh 8,000 by 1 lakh 2,000. That comes to 4.98. 4.98. So this 5 rupee likely to become 4.98, therefore it is dilutive in nature. It is likely to go down and it is reported. Is dilutive? This is reported. Now just imagine small change. If profit after tax is not 5 lakh, is 3 lakh, then what will happen? Basic EPS 3 lakh divided by 1 lakh, which is 3 rupee, and incremental amount, same incremental, same 8,000, same 2,000, 5 lakh plus 8,000 divided by 1 lakh plus 2,000. This will give me 3.02. You see, 3 rupees will become 3.02. It is going to increase. This is called as anti-dilutive, and this is not. So what are the things to be considered for dilutive EPS? Potential shares. When is reported? Only when the potential EPS is below basic EPS. Then what are the things to be considered? Savings in interest, or it might be savings in preference share dividend, and after tax. So interest into 1 minus t should be added to numerator, and denominator you should increase by number of shares. Clear? And then you should consider one more thing. It might be chance that it is convertible debentures during the year. Convertible debentures converted or issued during the year. Issued during the year means interest would have been proportionate. Interest would be proportionate for number of months. Number of shares also should be proportionate. So basically matching concept. Numerator profits, interest expense, if it is for proportionately for number of months, same proportion should be applied for number of shares. This will apply 2 times. At the time of issue of debentures, at the time of conversion, because issue can happen during the year, and sorry, uh, this is not 5 lakh, this should be 3 lakh only, not 5 lakh, 3 lakh, 3 lakh, not 5 lakh, 3 lakh. That's a mistake. Is the answer right? Answer 3.02, right? Answer 3.02, right? 3 lakh. Yes. So this proportionate thing will come in 2 times. In the year of issue, because you can issue during the year. In the year of conversion, conversion can happen middle of the year. In these 2 cases, the interest expense will be proportionate, and the denominator number of shares also should be proportionate. So in the year of conversion, up to the conversion, it will be part of dilutive EPS. After conversion, it will be part of basic EPS. And remember, this interest cost is not the coupon. This is the interest expense taken in P&L account. Interest expense taken in P&L account. Because interest you might pay 5%, 6%, but effective interest may be 6.02. So what will you take it to P&L based on effective interest basis? The effective interest is what should be considered as the basis for computing the incremental profit, incremental number of shares. Any other doubts? Please let me know. Okay, hope you are clear. Please confirm. Shall we go further? Okay. Now, next we have contingent shares. That is, shares issuable after satisfying certain conditions. Contingent shares, like they might say shares issued to employees if they satisfy certain conditions, vesting conditions would be there. Or you can say shares issued by company in the course of business amalgamation, business combination. If the company makes profit of 1 crore in the next quarter, the acquirer gives additional shares. Shares issuable upon meeting certain conditions. When will you consider in basic EPS? And when will you consider in diluted EPS? Dilutive EPS. Basic EPS is included if issued, that is, if contingency is resolved. If contingency is resolved, then from the date of whatever the contingency resolved, from the date of issue, from the date issue to take place, from the date of resolving contingency, from the date of resolving contingency. What if in the current year contingency is not resolved? It's not part of basic EPS. For example, current year, or let's say the shares issuable provided 3 years average profits happens to be 1 lakh. First year you made a profit of 20,000. Not satisfied. Second year you made a profit of 1 lakh 70,000. Third year you make a profit of 1 lakh 40,000. In the third year your average profit is crossed 1 lakh. So in the third year it will be part of basic EPS. From the date on which it is issuable, it will be part of contingent shares, that is part of basic EPS, proportionately for number of months, of course. Proportionately for number of months. Okay. From dilutive EPS, it is considered if condition satisfied, if when the current period is deemed to be the end of contingency period. Deemed to the end of contingency period. What do you mean by this? Let me give an example. Condition to be issued for issuing shares that company should make in 3 years total profit of, let's say, 10,000 rupees. Cumulative profit in 3 years should be 10,000 rupees. In year 1, they made a profit of 4,000. So year 1, you have not cumulatively added 10,000, so it is not there. Year 2, you made a profit of 8,000. So what is the cumulative profit became? 12,000. You crossed 10,000. So this will be part of dilutive EPS. One question you may think, sir, one doubt, sir. What is that? If you cross 10,000 in the second year, don't you think I will take it to basic EPS itself? Because I've crossed 10,000, that means contingency is resolved. Contingency is resolved means it becomes basic EPS. Why will you take it into diluted EPS? Contingency is not resolved. Year 3 is still pending. Sir, year 3 is still pending, but 8,000, 4,000, 12,000 already made. Next year, what if there is a loss of 5,000? What will happen at the end of year 3? 4 plus 8 minus 5. It would be less than 10,000. So you cannot say year 2 they have satisfied the contingency. No, in year 2 contingency is still pending. But if you deem this year 2 is end of the contingency period, year 2 itself is over. For the purpose of dilutive EPS, I am telling you, deem that okay, only 2-year period is considered. That is year end, the date on which you are preparing financial statement is considered to be the contingency period end. Deem it for the purpose of dilutive EPS. Will you satisfy the condition in that scenario? In this example, yes. Yes. For year 2, don't take it in basic EPS, take it in dilutive EPS. Year 3, let's say you made a profit of 1,000 more, contingency period resolved. Year 3, don't take it in dilutive EPS, you take it in basic EPS. Are you clear? Suppose if you make a profit of loss of the 7,000, 3-year condition at the end of third year, not satisfied, you don't take it in dilutive, you don't take it in basic. So when you should consider basic, when the contingency is completely resolved, that shares are issuable. When you consider in dilutive EPS, at the end of the financial statements, that is deemed to be the end of contingency period. Deem it. Will you satisfy the condition? Will you resolve the condition? Are you expected to issue? If this were to be the end of reporting period, if this were to be the end of contingency period, if yes, include in dilutive EPS. Otherwise, don't include in dilutive EPS. Hope you are clear in this aspect. Okay, let's go further. So this numerator denominator I've already explained. Date of contingent issued, exchange of liability when settlement takes place without change in the value of capital, like bonus shares, stock split from the earliest period, partly paid proportionate shares. Adjusted EPS, bonus shares, right shares, and accounting policy changes and all should be adjusted. Contingently issuable shares also we discussed. Dilutive EPS also have discussed. Okay, very good. So this is the theoretical aspects on earnings per share in Ind AS 34.